Good afternoon, ladies and gentlemen, in Singapore, and good morning to all our participants in South Africa. On behalf of the South African Chamber of Commerce in Singapore, I would like to welcome you to this morning and this afternoon's event. Another in the series where we're collaborated with ABSA, and today we also have the pleasure of being joined by one of our new members to our chamber, Tradeflow Capital Management, who will give you some insight into this topic of enabling trade in Africa through fintech and collaborative finance, and the challenges and solutions. Before we start the session, we are experiencing some slight technical difficulties. The session is being hosted from South Africa, and as a result of the blackouts that are taking place, it has certainly affected the communications and the bandwidth. So if there are some technical issues that arise during the session, please bear with us. We will try to deal with them as quickly as we can. What we're also going to do is our speakers will have their cameras off until such time as they are actually speaking, in the hope that we can save some bandwidth and keep things running smoothly. So the order of events today, we will allow our panelists, and we have two very esteemed panelists today. We have Michelle Knowles, who's the Pan-Africa Head of Trade and Finance Product and Governance at ABSA Group. And we have John Collis, the Chief Risk Officer at Tradeflow Capital Management, two experts in this field, who will unpack this topic for us. Both John and Michelle will give us some background to the topic, and then we will run the rest of the session on a Q&A basis. We have a number of questions to pose to our panelists in the hope that at the end of the session, we will have unpacked this and have given you some answers and some good information to actually use going forward. If you do have any questions, please feel free to post them in the Q&A, and we will then try to deal with those at the end of the session. So let's kick off straight away. I will shortly hand over to John Collis, who will give us some background to Tradeflow. Thereafter, I'm going to hand over to what has become a familiar face in this ABSA collaboration series, to Prem Naidu, the Head of Middle Eastern Asia, the Head of Middle Eastern Asia at ABSA CIB, excuse me. And Prem will give us some background into what is happening at ABSA, and will give us an introduction to Michelle. And we'll then jump into our panel discussion from there. So, John, it's all yours.
Mark, thank you very much. And thank you very much, ABSA and the Chamber, for having us here and inviting us on to speak to you. Tradeflow came about at the end of 2015, when Tom, James and I were looking around and saw there was a problem in the bulk commodity space for small and medium traders to access trade finance for what were fundamental supply chain transactions. The more we looked at it, the more we realized that this was going to be a continuing and ongoing problem. And it was caused because it was uneconomic, and it was becoming more and more uneconomic for banks to fund these smaller transactions, particularly back then for traders whose turnover was below $300 million, or for transactions that were in value terms less than $15 million. So we set about trying to work out and engineer how we could come up with a solution to that problem. And the solution we came up with was to not lend money. And the only way we could do that was by interposing ourselves and setting up a fund to actually acquire the bulk commodities and then in back-to-back transactions, purchase them and sell them back to the trader. In that way, we changed the nature of the risks that were being taken, and we made it possible to carry out these trades, and for the SME traders to carry out the trades. But the only way then that it could work was if it could be done on scale. And that was where the digitization and digitalization came in. So we spent 2 years working out how to do this. And finally, in 2018, we were able to launch our fund. And we've been going now for 3.5 years with an audited record. I think we're the first trade finance fund to have an investment grade rating for a senior note. And we've gone from strength to strength. And right now we have, I think in my last count, we had 35 trades into and out of Africa at any one time. We've done transactions with over 17 African countries. I don't know why I said Russian. And we continue doing them both into Africa and exporting from Africa around the world and from around the world. And that's TradeFlow.
Thanks, John. It certainly sounds like it's been a pretty interesting journey for you and your partners at TradeFlow over the last 3 years, and we look forward to hearing more about that experience during the course of the next hour. So straight from there, I'll hand over to Prem. Prem.
Thanks, Mark. I think firstly, just to say thank you to the South African Chamber of Commerce in Singapore, as well as to TradeFlow Capital Management for their collaboration to create this event. And obviously, we're very grateful. And I think it also, from an ABSA perspective, it demonstrates our ongoing commitment to build our franchise in Southeast Asia and Singapore in particular. I think for those attendees who are not familiar with ABSA and have not attended any of our previous webinars, just a few points. We're basically a leading Pan-African regional bank with operating subsidiaries in 10 sub-Saharan African countries. And we also have rep offices in Nigeria, Namibia, the United States, as well as the United Kingdom. So ABSA CIB is a full-service corporate and investment bank, supporting corporate clients from transactional banking to trade finance, treasury solutions, to a variety of financing products, as well as a full suite of investment banking products. My team's specific focus is to solution multinational clients based in the Middle East and Asia, which are looking to trade or invest in Africa. Singapore is a geography of specific interest and is a key market for our growth strategy. So with regards to the topic today, just if I can share a few of my comments. I think we're all aware that the demand for trade finance has declined as the COVID-19 pandemic has dampened world trade and disrupted global supply chains. From what I understand, global trade shrank in the order of about 7.5% last year. And with less trade comes, the need for less trade finance. And accordingly, there was a 9% drop in trade finance applications during the course of last year. Interestingly, banks intermediated an average of just 40% of Africa's trade flows, compared to 80% of other global trade. And the likelihood of trade finance applications by SMEs being rejected rose significantly as the pandemic heightened economic and financial uncertainties across the globe. So as the availability of trade finance reduces, and it's obviously essential to physical trade, one can therefore assume that the shortage of trade finance could have actually contributed to the lowering of global trade, in addition, obviously, to the lower other demand side factors. It's well accepted that African businesses face two significant financing challenges, one being accessibility and the other being affordability. And this obviously then restricts the options which are available to them. And therefore, SMEs in particular tend to resort to short-term bank loans, other forms of high-yield debt, as well as informal source of funds that are usually costly and maybe not even sufficient for the actual requirements. In previous webinars, we've spoken a lot of the African Continental Free Trade Area Agreement and its ability to accelerate intra-African trade flows. And we particularly focused on multinational corporate and their ability to benefit from the Continental Free Trade Area Agreement. However, the reality is that African SMEs are well placed to participate in intra-African trade growth, and provided that the right financing solutions are available, as well as the ability to trade, which can be assisted by the further digitalization of trade, this can be a huge boost to SMEs operating on the continent. I think it's also clear that digital platforms and innovation can be a major part of the solution set to encourage African trade finance. And we know that trade finance as it currently stands is paper intensive. So digital solutions, being platforms, innovations, products, etc., can certainly help to enable investors and businesses to engage with each other more easily, make it more efficient to source funds, accelerate their business growth, as well as contribute towards value chain enrichment, amongst a whole host of other positives. So maybe just to round up, I think Absa can certainly assist SMEs to raise trade finance. And we have been developing particular solutions around this, particularly to raise trade finance against contracts with large corporate clients. And we do this through what we call our enterprise and supply chain development area. It offers non-traditional finance to SMEs participating in corporate value chains, either as suppliers or distributors. The financing is on the back of the guaranteed cash flows, either from the contracts, the purchase orders, or the invoices. And I think important to state that our model relies on a partnership approach with our corporate clients, which provide those contracts to SMEs. And we in turn fund those SMEs so that they can execute against those same contracts. We also partner with various DFIs, such as USAID, as well as the Africa Guarantee Fund, who provide some risk-sharing instruments and allows us to participate in a deeper part of the risk pool. I think Absa fully appreciates the importance of localization and using procurement as a lever in supporting inclusive economic growth. And this obviously can be achieved through supporting SMEs. Maybe the last point is that Absa's continued to build out its ESG and impact investing capabilities to further encourage the growth of SMEs. And I think with those comments, I'd like to hand you over back to the panel and also to introduce you to Michelle Knowles, who's been with Absa for many years now. Michelle is the head of Absa's Pan-African Trade Finance product, and she's responsible for inter alia trade finance product innovation, development, delivery, as well as governance. So with that, across to the panel. Thank you.
Thank you very much. Thank you for that background and for the insight as to where Absa is at the moment and where you stand on this topic. And I think obviously what's become very clear is that there is obviously a huge focus here relating to SMEs and their ability to actually raise this trade finance capital that's actually required. And I think we will obviously try and unpack that and delve into a bit more detail. Michelle, would you like to do a quick overview before we jump into some questions?
Thanks, Mark. Just a very warm welcome to all those that have joined us. We're very excited to be talking around this topic that is so important from an economic and supply chain sustainability. I look after the risk and liquidity solutions, really from corporates, institutional, trade, as well as SMEs. So looking forward to the debate and questions. Thanks, Mark.
Great, thanks, Michelle. So I think with that being said, maybe we jump straight in. I think a good place for us to start would be a point that Prem raised in his intro about the trade finance gap and especially the challenges faced by SMEs in accessing finance. Michelle, maybe I can pose the first question to you. So we know that the access to trade finance remains a challenge. What is the quantum of the gap and some of the contributing factors that companies, particularly SMEs, face in the current market?
Thanks, Mark. I think I'll start by just reiterating that trade finance is a powerful instrument that, if well designed, really goes a long way to foster trade, and in particular intra-Africa trade, and also encouraging the regional integration. Whilst we did see a decline in the size of the trade finance gap, really from probably 2011 up to Q1 2020, significant challenges remain. And this runs into the billions of dollars gap in Africa in particular. I think in the coming years, Africa's trade will experience new challenges, but also new opportunities. The introduction of the Continental Free Trade Agreement, as Pramesh noted, is expected to eliminate significant barriers to inter-Africa trade and create a large market for firms across the region. However, at the same time, the ongoing health crisis caused by COVID-19 is impacting global supply chains and limiting the availability of dollar liquidity to support trade. Once this crisis recedes, the need for financing to re-energize the region's trade will be higher and more urgent than ever before. Access to trade finance, both the risk and liquidity solutions that enable SMEs engagement in cross-border activities through direct exporting and participation in global value chains, will ultimately foster inclusive economic growth and innovation. So it is important to ensure the sustainability of access to trade finance for SMEs across the region. SMEs, as we know, are the most significant contributors to African economies, yet they witnessed a higher share of their trade finance applications being rejected. This is even as the risk profile of their trade finance assets improved. So to make meaningful progress in addressing the trade finance gap, there are a couple of points that have to be addressed. The first is the regulatory challenges that have emerged as a significant drag on trade finance in Africa. Many banks listed regulatory challenges as one of the main constraints to expanding trade finance. So here we're referencing Know Your Customer, anti-money laundering, trade-based money laundering, as well as other regulatory compliance challenges. And this impacts not only regional banks and local banks, but also our corresponding banking relationships. In addition to this, of course, higher capital requirements that is required for trade finance place significant challenges on banks who are trying to provide these services to their clients. Of course, especially those that need it most, the SMEs. We have the issue of the availability of foreign currency liquidity and the impact that this has on accessibility to trade finance. And lastly, the data gap, which creates additional complexity, especially for credit information systems. This is not to say that there aren't many good initiatives already underway by industry bodies, development banks, regulators, banks, and fintechs. But we need these efforts to really address the challenges and enhance access to trade finance for SMEs and new trade finance clients. Thanks, Mark.
Thanks, Michelle. Feeding through from that, and you speak about COVID-19 and the impact that obviously that has actually had, probably not only on Africa's trade finance, but I guess in other countries across the world. John, if I can then ask you, you know, as Michelle has said, you know, COVID-19 has widened this gap for finance for SMEs. How is TradeFlow's solution helping to actually address this gap?
Thanks very much, Mark. Yes, we saw at the start of the crisis that the global trade finance gap was estimated at $1.5 trillion. And current estimates now, 2 years on, that is 1.7 trillion at least. The COVID crisis has affected SMEs particularly because the supply brake that it placed on smaller industries and smaller participants was massive. We can't overestimate the effect of closing down populations and stopping movement, and also the health effect of people not being able to get out to work and gather in harvests or move goods through ports. This was a real break on a lot of SME trade. And as countries now opening up, we're seeing a huge amount of demand for goods and commodities expressing itself. TradeFlow has been very, I hate to use the word lucky, but we've been the beneficiary of this crisis in one way. Our model was designed to be extremely robust and not rely on credit at all. So at a time when it was very, very hard to estimate a model credit during the lockdowns and the crisis, it was very easy for the TradeFlow funds to value and model out what they owned, because our model is based on ownership of bulk commodities with a liquid spot value. During the first wave of the COVID lockdowns, we had considerable amounts of commodities in bond as well as on the water and in trades. But because of our model, we were able to manage those, and because of the nature of what we deal in, so foodstuffs, energy, essential chemicals, metals, these were not held up unduly at any of the ports, and they were already highlighted as essential goods that needed to be transported around the world, and all the governments enabled that to happen. What we've done with our model is to change the nature of the risk that we take. So whereas a bank might lend money to an individual or a company and rely on their ability to pay the bank back, the TradeFlow model is fundamentally different. We interpose ourselves as a neutral principle between the SME trader and their supplier, and we will interpose into the same contract the SME trader would have had in their place as a neutral principle. So we don't negotiate the terms have already been negotiated. And we don't broker deals or introduce people one to another. That's already been done. What we do is we acquire the bulk commodities in our own name. And we take the risk on that, and that's why it's a genuine arm's length transaction. But at the same time, we enter into a contract to sell it back to the SME on delivery. Our security then is the value of the bulk commodity, and we have a maximum tenor for our transactions of 90 days. Most of them are a lot shorter than that. As a result, we can cycle an awful lot of commodities through the trade flow fund and get them back to the SME and get the trade moving in a way that a lot of banks just unfortunately can't. We're able to refresh the parts that other funders cannot reach. And that's how we've been able to keep moving throughout the COVID period. And well, we've doubled the size of the fund each year in the last 2 years, and we've now done nearly $1 billion worth of transactions for SMEs. So that's how we're hoping and managing to do it, Mark. Thank you very much.
Thanks, John. And I think it's always great to actually hear a bit of positivity, especially during this time of COVID and all the negative effects that have taken place. And you know, clearly, TradeFlow has developed a great model. If you're able to show that level of growth, especially during these exceptionally trying times, so well done. John, maybe I'm going to just stick with you for the moment and jump back to you if I can. Given the current state of tech adoption in Africa, and I mean, we're seeing ourselves the challenges that we're actually facing here in South Africa at the moment with tech, but obviously for different reasons. How does TradeFlow see fintech helping SMEs in particular?
Yeah, tech is a great leveler, and it falls into 3 very broad camps. So the first camp is if you like, the tech that has been around for quite a long time and was considered really groundbreaking when it was first used in East Africa using mobile phones to transfer payments. And that was a fintech revolution very early on. Allied with that, in order to successfully manage trades, not just for their physical well-being and understanding where goods are and what is their condition, but also to be able to cross customs and national borders with them. The technology has developed quite a bit, but the biggest uptick has been the availability of it and its acceptance and its security. And that was where, for TradeFlow, we were very lucky. We use a mixture of some cutting edge and brand new technology, but an awful lot of tried and tested and accepted technology that's been generally accepted. And it was the arrival of that general acceptance that's enabled us to digitize the physical elements of the work we do. But in order to make that work economically, you've got to be able to do it at scale. And this is where the fintech came in. So digitizing processes is the operation of getting pieces of paper and scanning them, turning them into PDFs and sending them around. But really that's just a quicker way of sending paper. The next stage is digitalizing them, and that's to get the data and transform it into ones and zeros. Now that's way beyond anything I can do myself, but we've got people who can. And what that means is from the outset, where if an SME can get onto the internet and can get into our website and log on, they can enter all the data that needs to be entered in to start the process of doing a trade. Now, this is really where fintech is meeting the everyday practical. We can identify people. We can, using the technology on mobile phones and the internet, we can do the same things that they do at the airport. So we have software that can determine whether the image you send us of your passport is actually a genuine image, and can correlate that to the photograph you send us claiming to be yourself, and triangulate that to show that it's coming from the place it's supposed to be coming from at the time it's being sent. And that's really just the first layer. And all this is available technology which we can use. Now, the work being done by the ICC and its Digital Standards Initiative is immense. And the same with all the people around the planet, whether it's the government of Singapore or South Africa or even Tanzania and Rwanda. These people are all developing digital and technological solutions that are being used every day by SMEs, and they're becoming more and more accessible. And by being accessible, if they can be accessed on a mobile phone, and an awful lot of people have mobile phones, then it means that we can move the accessibility to financing and investment much more deeply into the SME space and much more quickly. And the corresponding side of that is that when it comes to settlements and the transfer of credits and money, this can also be done now very much more quickly if in that space you have documents that have been digitalized and can be accepted against payments and can correspond with signatures and digital transmissions that show the receipt or the state of the goods as they're shipped or received, and where they are, and where risk is handed over and where ownership is handed over. This is how the fintech is coming to play a bigger and more important role for SMEs, particularly in Africa and Asia. And that's what we're trying to push, Mark.
Thanks, John. Michelle? And, if we, picking up on John's point there, I mean, obviously, for the banks especially, the authentication of documentation, and especially at the high level end of transactions, is obviously an extremely important exercise. And I would imagine that must actually provide its own challenges. Why do you think the digitization of trade finance is so important to actually reducing this gap, this trade finance gap?
It's a really good question, Mark. Digitization is viewed as a key enabler in democratizing trade finance. And, certainly the pandemic has accelerated the adoption of trade finance solutions for SMEs and corporate clients. It is a key enabler or mechanism for increasing accessibility and helping to close the trade finance gap. I think digitization of trade has always been at the front of mind for the community, but there's no doubt that the COVID-19 pandemic accelerated this transformation. I don't think we've ever seen the resilience of supply chains being tested more than during COVID. as a result of the lockdowns that the majority of governments had to implement to protect their citizens and try and reduce the rates of infection. This lockdown meant that we saw ports closing, delays in goods being dispatched and received. And we felt this impact globally and, of course, within our own markets, to the point that Prameshan raised, we saw the significant drop in trade finance last year, probably Q2 and beginning of Q3. And this was followed by significant recovery towards the end of Q3 last year. What was evident is that the disruption that originated in one location has and does have a significant global ramification, shortages of goods and subsequent demand and supply issues. And this highlights the need for organizations to look at how they build greater resilience in their supply chains to reduce the type of impacts we saw. At the core of supply chain resilience is access to finance. So trade finance does have a major role in playing to address or role to play in addressing the challenge of supply chain resilience. This reinforces the importance of access to trade finance. The COVID-19 pandemic also had significant implications for digitization of trade, as John mentioned. We saw the impact on the broader trade finance business, which has traditionally been very reliant on manual documents and which has been very paper intensive. And the epidemic or the pandemic has expedited the need for digitized trade and to increase SME access to financing by increasing operational efficiency and reducing the cost of offering trade finance, ensuring that we can enhance the portfolio of trade finance instruments, and of course, expanding the players that provide trade finance. And this will in turn increase availability and access to trade. We have in ABSA, and we continue to see an increasing demand for these solutions. So we have been accelerating our efforts to be a key driver of trade finance on the continent and to be an enabler of the free trade agreement, which of course is a critical step forward in developing and increasing the share of inter-Africa trade. This is particularly important as the share of, or Africa's share of global trade has dropped to below 3%. But we know that our intra-Africa trade still remains relatively below the broader benchmark. And this is where the true opportunity lies for trade on the continent. Thanks, Mark.
Michelle, if I can just stick with you there on some of the issues that you've actually raised. In order for these benefits of the digitalization to actually be realized, what would you as a bank see as the major challenges that need to be overcome in order for this to actually take place?
So I think although the majority of the industry has responded by increasing digital transactions and their trade finance digital capability, we have started to see global systemic issues emerging. And this includes tighter regulations and difficulty accessing sufficient foreign currency to support trade finance. To fully realize the potential of digitization as a mechanism to increase SMEs' access to trade finance, all of these challenges have to be addressed. There really has been a lot of focus and work being done around digitizing trade, and we know of many great technologies out there. So the question remains, why not greater take-up? And this really relates to the complexities and reach of the trade finance ecosystem and the number of players involved. So whilst we have seen lots of innovative technology, what has emerged is the concept of digital silos. And of course, we have to address all the issues and ensure that the full ecosystem is automated in order to really get the full benefit of digitization. So this means the entire ecosystem needs to support and participate. This is from regulators, logistic companies, banks, fintechs, really a concept that is emerging as a digital trade ecosystem, where there are secure online platforms that facilitate the exchange of data between parties that are involved in trade finance, trying to ensure that banks reduce the cost and complexity of digitization, naturally using technology such as cloud technology, AI, robotics will be critical, and this requires regulators to support and drive digital adoption across the industry. I think there are many initiatives underway that, again, are starting to look and address these problems. I think the three key that is a lot of discussion within the industry that needs still to be dealt and needs to be sorted and resolved is the issue around interoperability, so that we can facilitate coherent industry-wide solutions and not have digital silos emerging. Of course, in trade, standardization is key. It's a major issue. At the moment, that only certain parts of the supply chain, when it relates to trade finance, is digitized. So this means it's quite fragmented. And again, you know, if we deal the interoperability and we deal the standardization issues, we will overcome some of these challenges. And last but certainly not least, of course, is the regulatory change that fosters the adoption of these innovative solutions. And that fosters wider acceptance of, for example, the electronic documents, and that develop tailor-made approaches and policies to enable SMEs to really harness the potential of digital trade finance. And this will require very close collaboration amongst policymakers, banks, DFIs, and fintechs, so that the necessary synergies can be created and better complement one another. Thanks, John. Mark, sorry.
Michelle, are you, I mean, you're obviously, you know, very close to the situation and have a good oversight of it. Are you seeing this collaboration that you're actually talking about, this collaboration between the regulators and everybody else that's actually in the supply chain? I mean, we all know that, you know, trying to get a regulator in one country to actually do something can be rather challenging. You know, is it realistic to believe that, or are you seeing a willingness amongst all of the regulators to actually get this collaboration going, so that the process that you speak of can actually be effective?
So we've certainly seen a lot of positive movements from regulators, particularly as it relates to SMEs and trade financing. We're certainly starting to see a lot more liquidity policies in place that really provide for additional access to trade finance. I think on the digitization, there is slow and steady progress. We're probably not as advanced perhaps as some of the other markets, but again, probably the last 18 months has seen a lot of engagement with policymakers as well as industry bodies and banks to start re-looking at the policies that may prohibit some of the digital technologies being used. That probably will take time. And I think one of the key focus from the industry is, how do we accelerate those discussions? How do we ensure that that happens quicker? Again, so the benefits of things like cloud, AI, robotics, electronic documents are implemented far quicker.
Thanks, Michelle. I mean, it's positive to hear that the movement has started. I guess it can never happen quick enough, but it's positive to know that it has actually commenced and things are moving in the right direction. John, if I can switch to you, what is the gap that TradeFlow is attempting to fill between, you know, what the banks have to offer, obviously given the fact that they are so restricted as well by the regulatory environment and what they need to do, and what the customers, especially the SMEs, actually want and need?
Thank you very much, Mark. Yes, the difficulty for the banks is it's uneconomic for them to be able to lend to small transactions and smaller SMEs. In the past, an SME trader would have negotiated to buy $1 million worth of soya to ship it from A to B and have a contract to sell it for 1.1 million. And they go to the bank and say, look, here's my purchase contract, here's my sales contract, this is how much it's going to cost me to ship it. Can you finance 80 or 90% of this? And that's my margin at the end. There's not enough in it for the banks to be able to deal with all the regulatory requirements and the very low margin in physical commodity transactions. The money is just not there. The time and expertise required to manage it is too expensive. And as a result, that's a real break for the banks to be able to help. When you add to that the change in environment that happened after 2008 and the change in the amount of credit that banks are given for holding physical assets on their balance sheet, and also the amount of reserve they must put in place when they extend credit to people, it becomes even more uneconomic. So the problem we're trying to address, and which we are addressing every day, is providing the investment to enable SME commodity buyers and sellers to do their transaction in that space where the transaction value is below $15 million, and typically where the trader has a turnover of less than $500 million a year. We do a lot of transactions below $1 million, and we do a lot of transactions on continental Africa where we work with aggregators. So an example of that would be agricultural chemicals, which we enable aggregators to take into continental Africa, and then they can distribute to smallholder farmers, let's say micro businesses, at an economic rate, which is probably 12 times better than what they would do if they had to try and negotiate either with local banks or local grey finance. And then that's not the fault of the banks, that's just the environment in which they're operating. But as a result, we don't compete with banks either. Our role is a collaborative role, and we work with banks. Part of this discussion is about collaborative finance, and we, if you like, are able to reach those parts where the banks can no longer effectively go. So with that extra arm, if you imagine back when mobile phones first started, people were like that, and then they got a selfie stick. Well, we might be that selfie stick, and that way you can take a good photo. But as a result, we can enable banks like ABSA or other banks with whom we've worked participate with us. We can act as the first loss user under a risk participation agreement, and invite others to come in behind and participate in a way that they can do economically. And that's really the problem we're addressing.
Michelle, it sounds to me like there seems to be quite some opportunity here for collaboration between TradeFlow and ABSA at this point in time. But just following on from the question that I've put to John, and taking into account, obviously, this potential uneconomicability issue related to SMEs, what is ABSA doing specifically to support SMEs in this particular journey and in this particular trade finance issue?
Thanks, Mark. Trade finance has always formed an integral part of ABSA's transactional banking business. As we've discussed today, access to trade finance is critical to support African trade, which we know is a key enabler to economic growth. So, of course, access to trade finance will be key to facilitating these trade flows. We have and continue to see an increasing demand for these solutions, and we are accelerating our efforts to be a key provider of trade finance on the continent. And of course, supporting the free trade agreement, which is a critical step in increasing the share of intra-Africa trade. Our experience of doing business in Africa, our understanding of the low-risk nature of trade finance products are really strengthened by our partnerships with various development banks. For example, the CDC, IFC, as well as others, which has enabled us to access in excess of $500 million of trade finance funding in efforts to increase the amount of liquidity available. We also recognize the shift towards digital trade finance and that this would help broaden and simplify access to finance. So this is a key focus for us in supporting our growth strategy and something that we actually started 5 years ago in the business. We have a secure online banking platform that provides all our clients, corporate, business banking, and SME, with a comprehensive range of new functionalities. They can initiate, manage, receive the full life cycle of trade finance products. And this is from guarantees, letters of credit, as well as import and export trade loans and foreign bills for collections. And they can do this from the convenience of their office or from home. We have reduced the amount of paperwork, so this can all be uploaded electronically to support the transaction. And I think most importantly is access through our best-in-breed digital platform, which is ABSA Access. It really gives our clients a single access point for all their corporate and investment products. And this is across Africa. So this means we really are well positioned to support our clients and their business and to assist them to navigate the current economic climate. We will continue our collaboration with many partners to ensure that we are able to continuously look at what challenges our clients are facing and SMEs in particular and help to solve those. I think we've had very good success in certain of our markets supporting SMEs and providing access to trade finance by looking differently at the requirements and also ensure manage and work around the capital constraints that sometimes do occur. So I think we're well positioned, and we really encourage all our clients, both on the buyer and supplier side, to please reach out to us if you're interested in finding out more. Thanks, Mark.
It certainly sounds very progressive, Michelle. And I think as any business owner of an SME knows, the smoother and the easier we can actually make the process when we're actually doing these transactions, the better it is on the business.
Indeed.
We have, Michelle, John, we've got a number of questions that have come through on the Q&A, and I'm very conscious of time. Strictly speaking, we've only got 5 minutes left, but let's see what we can get through. So let me kick off. Michelle, maybe you want this one.
Yeah.
Do you think South Africa's legal framework is adequate for digital trade finance to blossom? Is it the right time for us to consider reforms like in the UK, where they introduced the Electronic Trade Documents Bill, or is our ECT Act doing just fine?
So I think that's a really good point, and it references some of the previous challenges that I noted and reliance from a regulatory perspective to reform some of the legal frameworks, etc., that make it easier to support access to trade finance through electronic documents. I think there is a lot of work underway. It has progressed probably in the last 12 months, but actually across the continent, we do still have some work to do with regulators, and hence why industry bodies like the ICC, BAFT, etc., are really collaborating with banks and other non-banks to work with the regulators, create and raise awareness, and understand what needs to be done in order to better enable this.
Okay, thank you. Michelle, let me just stick with you for one more minute, and I'll ask John the same question. The question that's come through is, do you work with all countries in Africa? How about trade between an African country and elsewhere in the world?
Thank you. I think that's a very good point. So we offer trade in all our presence markets. So as Praneshna noted, our presence in 10 markets. We've also formed a collaboration with SocGen to service the markets that we don't have a presence in, and thereby increasing our access and reach across the continent. In terms, we do certain products in non-presence countries. Naturally, from a regulatory perspective, there is some criteria around that. And I think on the trade between, so we service both trade between countries, that being intra-Africa trade, which is such a significant focus, I think, for the majority of us on the continent. But of course, we're also facilitating international trade. So that may be trade between a Chinese company, for example, or in the UK, as well as a counterparty within Kenya or Uganda or South Africa. So we service across both intra-Africa as well as cross borders internationally.
Awesome, thank you. John, do you want to have a snap at that one?
Yeah, thanks very much, Mark. At the moment, we don't. We've only so far managed to do trade with 17 countries in Africa, but we have ambitions to do trade with every single one. But I would echo what Michelle says. There are, of course, the regulatory issues, and we can't duck those. We can't sidestep them in any way. And obviously, there are some countries where it's harder to do trade than others, but that doesn't mean we won't do it. And we're absolutely agnostic, so long as it's within the regulations and it's not embargoed or sanctioned. I don't think foodstuffs are, that's for sure. We don't have a problem. We were very lucky that we opened up a novel trade, one that had never been done before. We'd been importing fungicide into Rwanda for use on the potato crop there. And we were approached by a large conglomerate aggregator who said, well, look, we produce lots of red beans, and we understand there might be a market in India for them. Could you arrange if we find someone to buy them and we aggregate them, can you step in on behalf of that buyer, just as you did for us in buying the fungicide? And we looked at it, we considered it, and in fact we were able to, and so there is now a route, an agri route out of Rwanda into India that previously didn't exist at all. I should stress that TradeFlow only does international trade. We don't do in-country trades, but we're part of a much bigger organization now, SupplyMe, and they do in-country inventory monetization. But the TradeFlow side, we deal with international trading into and out of Africa.
Thanks, John. I'm not sure who's best positioned to answer this one. any new developments on the creation of credit bureaus in Africa? Is information being shared by lenders cross-border? This could perhaps help banks get a much better snapshot of risk profiles of individual small traders. Michelle, have you got any insight into that?
Sure, I think that's a great question. I think one of the complexities that we face here is data privacy and how we ensure each of the regulators get comfortable with the transfer of quite sensitive information across border. In saying that, Afrexim Bank has done some amazing work with a platform known as Mansa, which really is intended to connect all countries, all banks, and share information, not just about credit and financials, but also around KYC, AML, which again all starts reducing the cost of providing trade finance or some of the complexities. So there is definitely a lot of focus and really some great work. If you haven't seen what Afrexim Bank is doing to support around addressing the data issue, I suggest you, I'm sure you can just find the information on their website, but there's definitely a lot of work. It's just working within the boundaries of current regulation and data privacy laws.
Okay. I think on that note, it does look like we've actually run out of time. We will go through the Q&A. If there are any questions that haven't been answered, that we haven't been able to get to, we will try and get the answers to those, and I think we will then look to perhaps post them on our website. There will be a recording of this session, which will be posted on YouTube, and we'll try and answer the remainder of the questions there. So in conclusion, if I could really thank our panelists, Michelle, John, Prameshan, thank you very much for your participation in this session. I certainly think that there was some extremely useful information that has been shared. And I certainly hope that our participants have gained a lot more knowledge around this subject as a result of your contribution. So thank you very much. And to all our participants, ladies and gentlemen, thank you very much for joining us. If you would like to find out any more information about the Chamber, please log on to our website, www.sacham.sg, or else you can find us on Facebook, South African Chamber of Commerce Singapore. We're also on LinkedIn, and you can find us on YouTube, the South African Chamber of Commerce Singapore. So as a chamber, we're obviously trying to maximize our use of technology as well, when we can get it to work. So on that note, everybody, thank you very much. Enjoy the rest of your day, and thank you very much for spending your time with us.
Thank you, Mark.
Thank you very much.
Thanks, Mark.
Bye.
Thank you.